Hey guys, welcome everybody. For those of you I've not met yet, let me introduce myself. My name is Brandon Wolf, and I'm a consultant specifically for investment advisors and financial planners. We work hard to bring you the cutting edge of investment strategies, investment concepts, and even investment platforms. And that make you, the advisor, stand out from every other financial advisor that you're competing against. So I know a little less than about half of you on this webinar have been through our integrated option strategy and are even using it with your clients now. And for those of you that haven't, just real quick, it's a mathematical concept of how we can integrate long-term call options into a portfolio that will allow your clients to get all of the upside potential of the market and at that same time hedging against the downside risk. So if you have not seen that, will you please email me directly after this webinar, and we'll get together on a one-on-one to go through it here. For today, though, we are here to introduce our Smart Mortgage program. It's one mathematical strategy, but there's a couple of different ways to do it, and I want to cover them both with you today. So I want to make sure that everybody understands that this program does not use equity from the home. It's a way to accelerate the equity positions in a fraction of the time that it would take a 30-year amortized loan to do. This strategy is using mathematics, and it combines a mortgage loan with a checking account, and at that same time building a new separate retirement account for your client. And we're doing all of this using the same amount of money that's being spent with their current 30-year mortgage. So we can change the financial future of your clients by eliminating a major portion of the interest that's associated with that fixed loan. So using dollars that are receiving little or no rate of return and then redirecting those funds to work much more efficiently. And again, all of this for the same dollars budgeted for your client's current mortgage now. So let's look at rate versus term. The interest rate of your mortgage, it determines the crossover point where your payment is paying more towards the principal than it is towards the interest. So most of the interest is paid at the front of the loan, which benefits the banks, but at that same time, it robs the homeowner of wealth. So you can eliminate a major portion of the interest paid on a loan if you'll retain the opportunity cost that's associated with that saved interest. So which in turn can create wealth, of course, if it's invested wisely. So you can see that even with a competitive rate of 4% on this, it takes almost 13 years before more of that payment is going towards the principal value than it is towards the interest. So take a 30-year fixed rate mortgage at 4%. We'll do the loan balance here at $200,000, and then let's see that 30-year mortgage. Let's see how it looks down the road at different intervals. So starting here right now, the loan, take a look at the first payment. So as you can see from the example, that about 70% of that first payment is going towards interest. You're hardly even making a dent in that principal balance. In fact, you'll have paid off less than $3,500 in principal during the first year of that loan. So moving it down the line here about 5 years, your principal portion has only increased by about $65 per month, and you still owe 90% of that original loan amount. So we take it further down the future after 10 years, you've only reduced the principal balance by $42,000 now. And after that point, nearly 13 years into the loan, you'll still owe a balance of $142,000, or more than 70% of that original loan balance, and you're nearly halfway through that loan term. So the moral of the amortization story is it's slow. It's a slow process, and which is why it's important to get your clients doing something different than this to positively impact their future retirement. So with this strategy, you can see the Smart Mortgage program has that mortgage paid off in 9 short years, and allowing your client to invest the amount they would have paid to the bank on that traditional loan. So this will have a significant impact on their retirement without having to save more or changing their current lifestyle. In this example, the home would be paid off 21 years earlier than using that standard 30-year mortgage. So it's important to note also that this program is not a new concept. It's been popular for years in other countries. Over near Australia, it's called the offset mortgages. Western Europe, they call it the current accounts. Closer to home in Canada, they use the money merge accounts. And now here in the States, it's mostly being called the all-in-one account. So it's not new at all. We're just slow in getting it to work for the clients. So this mortgage program is combined with a checking account, and it's got all of the same basic components of a normal checking account that you and I know with any other bank. So any money deposited into that checking account will buy down on the principal balance and therefore reducing the daily interest charge. And by moving from a 30-year fixed mortgage with normal principal and interest payment to a new loan that's interest only, we freed up monthly income that we can redirect to a retirement investment for your clients. So how does the plan work? The plan ties that mortgage to a new zero balance checking account. It allows you to direct your clients' passive or their low yielding assets. And for example, that would be like money sitting in a savings account and in their checking account. And let's say that they even had maybe $10,000 in a short-term CD, earning 1.5%. They're keeping it in these places so that it would be liquid, available to them at any time. And they do this knowing that they're giving up any type of gain on that. So since that checking balance is swept over the mortgage ledger each and every night, by reducing that loan balance, the interest calculations are positively impacted. And because that daily loan balance is lower than the originally calculated at that start of the new loan, the slide shows you how that all-in-one loan work would work over a month. So money coming in and going out over that 1 month period. So let's take it from the top here. The total combined income for the household is $7,000 net deposited into their new zero balance checking account. So that's paying down that mortgage balance of the loan, and it'll bring the new balance down to $393. That night that account swept over that mortgage ledger. So the reduction in monthly principal and interest payments, taking them from a $1,852 a month, putting them in the new loan product where they'll be pushing out only $1,242 a month, and then we're redirecting that $600 a month for a side account to work for their retirement. So this family has about $2,500 in monthly expenses, and this is not including their mortgage payment. So all of the bills will be paid out exactly the same way as a traditional checking account, which moves the loan balance back up to the $395. So you can see when the money comes in, it brings it down. So every day it's working for you as it sits and waits to go out to pay bills such as the direct TV or car insurance and groceries, and it will bring it back up as those checks or debits come back out of the account. So every day that money is sitting in there, it's actually working on the benefit of your client. So the mathematics of it, and we want to take a look here, is with a 30-year traditional mortgage, the borrower ends up paying nearly double the original loan amount. So with the Smart Mortgage Plan, a significant amount of that interest is saved due to the structure of the loan. So what happens if we're able to change the mathematical equation of the loan? So if our new equation has more flexibility and it's more efficient way to borrow, the formula can be changed to benefit the borrower as opposed to the lending institution, saving a large amount of interest in that process. And by doing so, we can change the financial future of your clients by implementing the strategy. So I want to move forward here. Let's look at an apples to apples comparison of two identical couples. The only difference is the way they actually finance their home. Their ages are going to be the same, mid-40s, net income after all taxes and insurance removed. Maybe they've contributed to their 401k. We're going to put their expenses at $2,500 a month, not including the mortgage payment. And we're going to look at a fixed rate mortgage, about 3.75%, and we're going to start at $400,000. So our first couple, James and Allison here, they use a traditional 30-year fixed mortgage with their current principal and interest payment at that 3.75% is about $1,850 a month. Our second couple, Tom and Barbara here, they're going to utilize that Smart Mortgage loan as the primary loan, and they're going to be moving to an interest-only payment, around $1,200 a month, and we're able to redirect that $600 off to a different account to build for their retirement. Everything else is completely identical. The assets, liabilities, when money comes in and when it goes out of the account, income and expenses. So let's take a look here. And this would be after 12 months, our first couple with a 30-year fix, their mortgage balance is down $392. They've applied $7,300 towards that principal. In that same 12 months, our second couple, that mortgage balance is down to $365,000, and they've been able to put almost $70,000 towards that principal balance. Look at the difference there, and this is just in 1 year. So let's go even further down the line and take a look at this thing after 9 years. Our first couple using that standard 30-year fixed mortgage, they've got their balance down, and this again is 9 years, a little over $300,000. Our second couple in that same 9 years, only thing that's changed is that mortgage product they've done and moved into. Everything else has remained the same. They've actually owned their home free and clear. Look at the difference in value over a 9-year period of time. So with that case study and comparing the two loans, our second couple saved over $195,000 in interest, or close to. We're able to redirect a little over $73,000 for an account for the first 9 years, and then the 10 to 20, we were able to push out the entire $1,952 that they would have put towards that mortgage. So by utilizing their passive or low-yielding money of $2,600 that just kept going and growing every single month, they were able to pay off the home much quicker. So what do we do from the 10th year moving forward? Remember, after year 9, that entire principal interest was originally budgeted for their fixed mortgage of $1,852. Well, after 9 years, now we can redirect for their retirement the entire $1,852. So at the end of 30 years, our first couple now finally own their home. Congratulations, and they're on track for retirement around 70. But by utilizing the Smart Mortgage program and simply redirecting those funds, our second couple was able to pay off their home in 9 years and build a retirement account with close to $1 million in it. So even after that loan is paid off, it still provides another 20 years access to those home equity dollars. So just because they have that home paid off and have a zero balance at year 10, they still can utilize that money to actually do as far as leveraging goes or have that credit line available. And it basically goes down from that 30 year at the start all the way down to a zero at the end of the 30 years. So it's more of a tapered type equity loan situation. So let's take a look at the mortgage calculator, and it's where you're able to run a side-by-side comparison customized to your client's individual variables here. So in order to run the calculations, we need this information. We need total and combined income. We've got to cover the household expenses, and this would be separate from their mortgage payment that goes out. What type of mortgage loan they're currently in right now, if it's 30-year fixed, what their balance is, and the current interest rate that they've got that locked in with. If they're not sure on those numbers, but they know when the loan came out and what that starting balance is, if they've got their interest, we can actually calculate for them and know what their balance is really, really close to. So once we're able to enter all that data, we can then show a side-by-side comparison with them on what they're doing now versus utilizing that Smart Mortgage program. So now this calculator I took, back up here. So this calculator I took right here was from one of my advisors that actually recently used this program. This is a real live situation where they use for their client. They've got their total income coming in net after everything's paid around $11,000. Got their expenses around $3,500. Right here, the additional that we talked about would be if that money was sitting in a savings account or a low-yielding CD. They were able to move this thing and set it inside of that checking account, and it basically bought that principal down by $20,000 and stays in there that entire time. It's giving them all of the liquidity that they want, but it's actually doing work for them. So this is how the side-by-side comparison looks for them. On the left-hand side, this would be their standard 30-year note. This is what it will look like over 30 years doing what you're doing now. If we move you over to the Smart Mortgage loan, take a look at the difference of when that mortgage is paid off. They've got it calculated here in about 7 years being able to have that mortgage paid off, utilizing their passive or low-yielding income, saving over $300,000 in interest that they were doing. What a difference that can make as far as the financial outcome for your clients at retirement. So this one right here where the advisor, he utilized an IUL. And so he put this illustration off, and how he had it was when we moved him into the new loan, we were able to redirect that $1,000 a month for the first 7 years. And then from 7 on, he was able to direct the entire $2,736 for this illustration. So under this IUL, look at the difference here at death benefit at age 70. But they're now able to take this cash value and have it distribute out through their retirement, and what a difference that could make in how their retirement goes. So I've seen advisors use lots of different growth vehicles. I've got advisors that redirect that savings directly to the market, utilizing ETFs and index funds, and even the S&P 500. So take a look here at this illustration. Just so you know, the S&P 500 since 1871 has averaged around 4.6% to about 5.85. So I've just calculated this illustration right here at 5.5% annual growth for the first 7 years. They were able to redirect the 1038 a month, and then from years 8 to 30, they were able to redirect that entire 2736 a month. So look at the end of 30 years. I mean, we're talking almost $2 million in growth just simply redirecting those funds. Again, that's just following the index with the S&P 500. So you've got to evaluate every single client. They've got a unique variables that must be taken into account, and look at the entire picture. So remember that this strategy is not for everyone. It requires excess money at the end of every month. So they've got to spend less than what they make and allow that to accrue and work for them. So I would say focus at the top 40% of your client base to look to enhance what they're doing. But when you evaluate, take a look at both risk tolerance and time horizon when you're deciding if this is the right strategy for them. And we talked at the very beginning about having that same strategy but 2 different ways to do it. I want to quickly show you the other way that's able to use that the mathematics, and it's the same thing, same concept of utilizing their passive or low yielding income, combining it with a checking account with their home equity line of credit. So the other way to utilize this is to keep that 30-year fixed mortgage in place, and then have the client take out a home equity line of credit and send the check from that HELOC to the primary mortgage, and yet you're still going to keep paying that $1,962, even though that it's been brought down. So, and just the same, it works by pairing that client's checking and savings account with that HELOC loan. So their excess money will be doing the same thing. It'll pay off that $25,000 HELOC. And as soon as it's paid back in full, we do the exact same thing again. We'll send that $25,000 to the primary mortgage. It'll buy it down. We're still going to make that payment of $1,962 and allow the mathematics to work for us. So we're going to want to cycle that, 2 to 3 times a year. And so there are positive and negative drawbacks of using this strategy. So we'll go over them both here in a bit, of the positive and the negative. So let me show you how the calculator actually works on this one here. Give me 1 second. Let's pop it up. So right here with expenses, we still need to have that same information. We need to know this is a way for your clients to list it out if they'd want. Just for illustration purposes, just put it in other, and we're going to put their expense about $3,500 a month for all of their household bills. So moving forward here, we need to have both husband and wife with the income coming in. First is make about $5,000 a month, and then let's put second about $2,000. We're going to have the total net income. This is after, again, all taxes and insurance have been out. They've made their 401 contributions. This would be net coming into the checking account. And then let's do the home here at $500,000 is the market value. They're in a good state, a little over 80% loan to value. And let's just, for illustration purposes, put it as a new loan right now. So out of that 36, we'll put 360, and then let's give it a competitive rate of return around 4%. And this would be when they pay bills. So the expenses come out. Let's say that they pay their bills out on the 5th, and mortgage payment out is on the 15th for that primary. With the HELOC amount, and you can kind of play with these, and it doesn't really make that big of a difference depending upon it. It's more of just play with it based upon how much they can get and what their excess income is, because we're going to want to cycle as much. So for this purpose, let's just do $25,000 as the HELOC, and we're going to do this starting right now too, year one. And let's do your HELOC amount in second position is normally a little bit more expensive as far as interest goes than that first position. For this calculation, let's just put 5.5%, and you can play with those numbers as well depending upon your client's variable. So let's see how it all comes together here at the end. They've got that original loan balance, $400,000 on that 30-year note, principal and interest payment. This calculates the net income that comes in. It shows the expenses going out for the family and talks about how much money at the end, after all bills have been paid, what do we have is excess surplus that can work on the client's behalf. In this illustration here, almost $1,600 is extra, so that's going to be able to compound through the months. And look at the difference here. On the left-hand side would be the same thing that we looked at the other. If you continue on the direction you're doing, this is exactly how it will look over that 30-year period of time. So look at it using this with that HELOC amount. They're able to have that home paid off in the first 13 years and allowing that passive income to work for them. And it looks just as beautiful as the other way. It's a no-brainer that the strategy works. It's just a matter of which way is the better for your client. So coming back here, and let's talk about the differences between the two different. So let's take a look at the alternative for that second position HELOC. The disadvantage that come with that is the HELOC is in second position and it is utilizing equity from the home. With a second position HELOC, you're not as able to get as big a loan amount, so you don't have as much liquid capital that's available to you anytime. And it's not near as efficient as the first way we looked at, and it will increase the budget amount just because they'll have a little bit more of an interest payment utilizing that HELOC that'll come with it. The other problem is we're not freeing up any capital from year one to redirect out for that separate retirement investment. And if you'll remember back to the 2000s and then after the 2008, is these banks that had people with those home equity lines of credit, they were closing them down just to basically close that risk up. So you don't have that type of protection against it. Some of the advantages that come with it is much easier to qualify for, and in some cases it's not actually in your client's best interest to pay off their home. So make sure that you're taking into account the tax benefits by having your home loan and weigh this thing out. And then less risk depending upon their current mortgage that they've got. And again, take it every one of them case by case to run them through the system and find out what's going to be the best answer for them moving forward. So we have a great team of experts put together, and they're here to help you guys. So reach out to us with any questions that you got, and we'll get them handled. So a question that came up from our last webinar that I want to make certain everybody knows is we are not a mortgage loan originator or an insurance producer. So we're simply looking to bring great strategies that can help you guys build your practice and also build your client's monument, which is what you've been tasked to do. Our next webinar will be with the actual mortgage experts on how that first position all-in-one loan functions. It's important that you understand the mechanics of that loan so that you can properly advise your clients. So please email me if you'd like to be on that next webinar, and also feel free to email me directly with any questions that you've got. Guys, I hope we get the chance to work with all of you. Look forward to it, and catch you on the next one. Thanks, guys.